Hello, everybody, and happy Monday. Well, you'd probably have to be living under a rock here for the last week or so as we've watched the stock market go down, down, down. I'm going to take you back about a month. And remember when we showed you I call it the squiggle chart, and it shows all of those bubbles going back to the 1960s and the one, let's see, looking at it here. Oh, yeah, way over here. That was the Magnificent Seven bubble of these tech stocks that pushed the whole market higher. And it was the highest run we'd ever seen on any of these squiggles, going back actually to 1929. And we said, watch out, this thing's going to roll over. And sure enough, here we see this thing heading south. Well, I ran across a letter from about 23, 24 years ago written by the CEO of a company called Sun Microsystems. For kind of you old timers out there going, oh yeah, I remember that name. That was a darling stock of the dot-com era. And it was. They had a nice little company. They made computer hardware and software. The stock had risen from $3, $4, $5 a share. And then during the dot-com mania, up it went to $64 a share. And then the thing began to roll over, just like what's happening here. By 2002, it was back down to 5. And that's when the CEO wrote a letter to the shareholders, the people who bought the stock, the regular Janes and Joes who bought it during the mania. And he basically chastises all of them. And here's what he wrote. But wait, before we get there, some of this jargon is going to be a little bit hard, but when you decide to buy a stock, when Walt and I think about it, there are certain things you look at. You might buy a stock for the dividend. Let's say the dividend is 7%. Well, if you hold that stock for 10 years and you're making 7% a year, you've pretty much gotten all your money back, plus you still own the stock. That's one way to look at whether you should buy a stock or not. The other way might be profits. How much am I paying for $1 per share worth of profits on this company? Are they making enough profit where I think I'm going to get my money back in how many years and I'll still own the stock? That's called the PE ratio, price to earnings ratio. Well, back then, Wall Street was selling stocks not based on dividends, not based on stocks, based on sales. Let's pause it. Wall Street is not an investment organization. I know that's hard for most of you. Wall Street's a sales organization. And Wall Street's got the best salesmen, the best saleswomen in the whole wide world because they can afford it. They convinced a whole generation, a quarter of a century ago, don't worry about dividends. Don't worry about profits. That company is selling a whole bunch of stuff. Well, yeah, but are they making any money? Well, don't look at that part. Well, what are their costs? Well, don't look at that part either. Just look at how much they're selling. And people bought into it. Thus, the Sun Micro story. Here's the letter from Scott McNeely. And he said, Dear stockholder, this became very famous, by the way, at 10 times revenues, sales, to give you a 10-year payback, I have to pay you 100% of my revenues for 10 straight years in dividends. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. He said, that also assumes we have zero research and development for the next 10 years. Now, having done all that and knowing all that, would any of you like to buy my stock at 64? You don't need any footnotes here. What were you thinking? Signed, Scott McNeely. And he was right. I can imagine him sitting at his desk in 2000, 2001, or 1990 as the stock is going up, 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 up. He's going, I know my company. We're a nice little company, but we're not worth $64. First down, she went to 5. I think they ended up getting bought out by Oracle at about 9. And it's just another .com story. So why do I tell you that? Look at this chart. Thanks to the good folks over at Hussman Research or Hussman Analytics. You see this part right here, that mountain, that's price per sales of the tech sector .com era. You see that 7.9 times? That's what McNeely was talking about. He was at 10 times. This was 7.9 for the whole sector. Where were the tech stocks, mostly AI, selling sales, but not selling profits, not selling dividends at the end of 2024? Right there. 9.9, almost 10, right where McNeely was. Another generation is about to learn a very hard lesson. You can't just buy things based on a story, based on potential. Yes, .com changed the world. No doubt about it. Yes, AI is going to change the world. No doubt about it. But the companies are different from the story, than the technology. The stock is different than the company. And the stocks are at nosebleed levels and they're just now rolling over. If this sticks to a historical norm, the low end for a correction in the overall stock market right now is 50% to get back to where we could grow organically in a normal way. Most consensus that you hear from guys, the old timers, it's got to fall more than that, 70, 80%. That's what happened to .com. The tech sector fell 80% from top to bottom. What I'm saying is, I am really happy where we are right now because you're not invested in this stuff. And you saw what happened last week. The market continued down. Gold went up, silver went up, copper went up. Your portfolios had a pretty good week when almost every other portfolio out there didn't do so hot. I believe we're on the right track. Let's see how this unfolds over the next several months, but I believe we're in the right sectors. With that, I'll turn it over to Walt.